The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. This is Larry Pesavento for TFNN. And today I'm going to take us down memory lane and look at some of these really long-term charts just to reiterate the importance of these Fibonacci numbers and some of these cycles that we're looking at. And what we did in Tiger TV today is we posted the chart of the Dow going back from 1986, which will include the crash of 1987, and it brings us forward. And when you look at the chart, this is going back a monthly Dow chart. That Black Monday that you see there on the far left in October of 1987 looks like a little tiny blip on the chart, but it was in fact one of the worst days in the history of the stock market, as in fact it was the worst history, as the Dow was down 16% that day. But what was interesting is the overall pattern that has emerged through the past 25 years, and that is the fact that we have come down to the in March of 09, when we hit that point of no return. That was an exact 61% retracement to the exact Dow tick at 64.54. It was exact 61% retracement off the low of the 1987 crash when the Dow hit 1,660. Now, there's another point there that I'm not able to bring up on the chart because the monthlies did not go back far enough, but it went back to 1982 when the Dow was trading at around, I believe, around 750. That number came in at the 50% retracement of that move. So there were two big numbers that came at that point, and since that time, the market has been going up. But if you take a look at this chart, you'll see that the high that we made back in October of 07 was an exact 1.618 of the yearly high from 2000 down to 2003, and then it expanded up to the 1.618 retracement to the exact tick at 14,390 in the Dow Jones Industrial Average. So that just helps you realize that these numbers, even though they don't work all the time, they do work some of the time, and they're quite accurate. And we want to be aware of what's happening. And we're over one of these time frames right now that is what I believe, mathematically and geometrically, very, very important. And this is why I'm trying to, show some of these charts that we're looking at, over the years that that I've actually seen these things, unfold. And if we go back and take a look at the importance of what this number of 1307 is that people have been talking about on the internet and also in Tiger TV and things. But this is my best recollection of what I think is happening, based on the cycles and things that I look at. And I'm going to put in the Tiger Den now, the monthly S&P cash index going back to that same low at 1994. And you'll notice that when the Dow was hitting the 61% retracement of that 1994 low, the S&P was making the exact 786 retracement of that low. And that the reason for that is the Dow is only 30 stocks; they're unweighted, and so it's easy for stocks that are unweighted and only 30, which is a horrible sample size, to do something to that effect, make a higher number than the actual market, which came in at the 786, which was down at the 666 level in the S&P futures at that time. But this chart going back to 1994 shows the double top that occurred during that time. And the importance of this chart, and I believe it's incredibly important because I based a lot of things on the cycles that I've looked at, was the low that we made on August the 15th of 2007. That's when we had 6 planets lined up with 6 very important cycles, and I said at that time that we were going to rally from that point, which we did. We went up into new high ground into October of that year, but I mentioned that if we ever took that low out of October August the 15th of 2007, we would be in a very severe bear market, and this market would be, based on a debt repudiation cycle, not so much about stocks, but, related to bonds. And that's why I've, been waiting for this, particular pattern to fulfill in bonds. But this is why the 1370 is so important in the S&P, is that we're up at this level right now. Now, what is interesting is, even though we are at this level, coming up to the 786 on the monthly cash on the S&P, the New York Stock Exchange futures, the New York Stock Exchange Index, which is the best of all the indicators because it's a weighted average, gap weighted, and it has many more stocks, has thousands of stocks in it as opposed to just 500, and that's why I believe that it is a, far better indicator of, what is really happening, with the market, as it's actually going. And so if we keep in mind that this is something that is relatively important, we need to watch that index because it's 10% under, where the actual market actually is. Now, if we go to a daily chart on the S&P cash, you're going to see that we are, right up at this level where we're making a double top pattern. It's done it in perfect fashion where we've made an AB equals CD level from that October low, and then we had the low into the new moon of November the 25th, which was a huge buy signal because of, you had that 61% retracement and had a very strong seasonal at that time, and the market, exploded, and it now has made a double top in this area. I don't know if the top's going to be made today, tomorrow, by March 10th or whenever it is. All I can tell you is all of the evidence is pointing that we are at something very, very major, and I will try to show you the relationship between 2007 and 2012 and where we are in relation to on the way the market is going up as far as the number of advanced declines and how the NASDAQ, is the leader of the market, and basically it lulls people into believing that, they're in a big bull market, which in fact, that is really not the case. And, this is what the whole first part of this radio show today is going to be about, because it's important enough that we should be able to, see that, we have some major divergences occurring, and even though that they look like they're not important, that they certainly are. And we want to take a look at the Bradley model and, where that stands for the rest of the year, and, get an idea that this is, some of the things that we have to be looking at, when we're watching these things. So the next thing I want to do is to start with, the divergences, that I'm seeing in the market. And the first one I'm going to bring up and to let you take a look at is the divergence between the Dow Jones Transportations and the NASDAQ. And when you see this chart in Tiger TV, you'll realize that and of course you don't have to be a rocket science to look at this, is the fact that you've got a big move coming in the NASDAQ where it has exceeded the July highs by 1.618, and yet the Dow Jones Transportations has not even exceeded the 786 retracement, and in fact been going down for several weeks. That's a very important divergence. Now people say, well, these divergences don't mean anything. Well, historically, if you go back and look at these divergences, they mean a great deal. Many times they will give you a really big tip-off of where the market is actually heading, and this happens to be the Dow Jones Transports. Now, if we take a look, and I didn't bring the one for the utilities because it's such a small index, I didn't want to bring it out, but the utility index looks almost exactly similar to the Dow Jones Transports, and when you overlay the NASDAQ market on top of it, you'll get an indication that it's just been, one-way Corrigan. It's basically Apple and some of these other large stocks in the NASDAQ 100 that is pulling the market up. And that has happened several times in the past. If you go back and look what happened in 2000, that was the exact same thing that happened in 2000. And so you want to realize that these patterns, they do repeat, and when they repeat, they usually leave a trail of blood, down the road, and this is what we're trying to prevent you from, stepping into, the quagmire of, what could actually, happen with this. So the next one we want to look at is we want to keep an eye on, where we are right now with the NASDAQ and how it looks in comparison, to the New York Stock Exchange Index. And if you'll take a look when you go into Tiger TV, it goes back, way into May, and you'll see that since May we're making a 78.6% retracement. And I drew a dark blue line across this to show you that the NASDAQ has exceeded the highs of July by better than 1.618, whereas we've only made a 78.6% retracement in the overall market, which is the New York Stock Exchange Index. So that's an important thing to look at. We've also completed the AB equals CD leg, which completes the bearish-Gartley in the New York Stock Exchange Index. We have also made a double top in the Dow Jones Industrial Average. We made a double top. That's from the July highs, not from the all-time highs, but we've made a double top in the S&P cash, and we've also made a double top in the Dow Jones Industrial Average. The overall broad market, which is the New York Stock Exchange Index, is still lagging badly, and it certainly is. It's still in a bear market because you have lower highs and lower lows, and you've completed a big, AB equals CD move, within that time frame. So that's what I'm looking at as far as that. Now what we need to do is to go back and look historically of what's happening with the NASDAQ and the S&P, the New York Stock Exchange Index, and go back to 2007 and see if there was any indication that maybe this same phenomenon was occurring. So what we want to do is we will go in and we will take a look at the NASDAQ, and we will take a look at the New York Stock Exchange Index as it existed in 2007 when everything was great and we didn't have any particular problems with home ownership or credit default swaps or mortgage-backed securities, any of those things. But if you'll look at that time, the New York Stock Exchange Index was also making a double top in October of that year, just marginally. And then if you would look at that dark blue line again, where I measure the relationship of the NASDAQ to the New York Stock Exchange Index, you'll see that the NASDAQ was making far new highs above July, again at a 1.618 expansion level. And this was, fooling people to thinking that the market was actually much stronger than it is, but in fact, it didn't. And you can imagine, the prices went, considerably lower than, where we're showing on this 2007 chart that the market broke a great deal. The reason why I bring this out, folks, is these divergences do mean something. I think they're very important, and you should take some time if you get into Tiger TV to look at these. They give you a really good idea of what happened in the past, what's happening in the future. They don't always work this way, but everything is setting up that it's interesting that it's all coming together at this particular time. We've got a commercial to come in here now, I believe.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective and maximize your returns. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, co-host of The Money Masters with Tom O'Brien, seen daily at TFNN.com, author of Mastering Probabilities, a daily investment and trading newsletter, and teacher of the money game. Studies show that 3 out of 5 people are afraid for their life in trading these markets, and the number one reason given is fear of loss. Look, fear stands for false evidence appearing real, and the money game proves it. Lesson number 1, don't risk more than 1% of your trading capital on any trade. Why, you ask? Because 35 trades in a row where you risk 50 cents and make $1 are all you need to double your trading capital, versus the 230 losing trades in a row you would need to bring your balance to $100. Let me teach you more about the money game risk-free for 30 days. Go to the homepage of TFNN.com and click on my name, Steve Rhodes, for your 30-day risk-free trial. You were born to be a money master, and I'll teach you how.
X-Story Gold Mines, an NYSE Amex-listed company trading under the symbol XG, is slated to be the newest gold-silver producer in Argentina. X-Story is forecast to produce more than $250 million in bullion annually, beginning in 2013, at a cash cost of less than $200 for each ounce of gold produced. That forecast will make X-Story one of the highest margin operators in South America and a sector leader in the mining industry. X-Story has $50 million in its treasury, having spent over $60 million to date on drilling and engineering. The ultimate size of its Argentina discovery could be determined by year-end, as results from the 6 drills operating at the site are fully assessed. To find out more about X-Story Gold Mines and their exciting growth potential, click on their banner on the front page of TFNN.com or check them out on the NYSE Amex under the symbol XG.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, we're back, folks. If you have any questions, it's 877-927-6648. And the next chart that I posted into the Tiger TV is the VIX index going back 6 years, and it shows that we're back into that major area where there's absolute complacency in the market. There's no fear at all. The Greek thing looks like it's been taken care of, and all the other problems just seem to be out of the way, and we'll just wait and see what happens. Now, the next chart that I wanted to place into the Tiger TV is the futures for the S&P 500, because we are completing a major AB equals CD pattern up at this 1370 level, and we've already went back and looked long term to see where that level is. That happens to be the low of the day of August the 15th of 2007. I remember that day very vividly because Tom O'Brien and I were speaking on Skype, and Skype went down that day. It was one of the few times that it ever went down. And, the market was amazing that day because the Dow was down 350 points, and the Russell Small Cap Index was actually up on the day. And the NASDAQ was down just marginally. It was only the S&P and the Dow that was hit. And Tom said, you better start buying now because this is it. And that was a big Astro day, and the market did turn around and go up in a new high into October before it finally broke. Now we've come back to that level, and that's not unusual for markets to return to the scene of the crime. And this is why we're at such an important level, I believe. And, I could be totally wrong here, and if we, blast through, 1,400 on the S&P, that's certainly going to tell me that all of this work that I'm working on is not right. And, so we'll have to wait and see if this is going to be the case. But, right now we just have to, see what happens over the next day or two if these markets do actually, every time they push it down, it comes right back. And that's basically because everybody is scared to death to be short, including myself. And so just remember that, you can it's nothing wrong with being wrong. The real problem is if you're staying wrong. And if we close, above, that 1380 area, 1385, this most certainly means that this is not working at this time, and we'll just have to, wait and see what's happening. But we're getting close with the Bradley model. We're only a few weeks away from a major turndown in the Bradley model, and it stays down for all of 2012. And I'm going to do something just to give you an idea of what it looks like on a much longer time frame. And I really don't want you to realize that this is, trying to think that I'm a perpetual bear or anything like that. All I wanted to do was to show the long-term, Bradley chart going through, 2015. And remember, this can invert, and all it means is that the cycle is basically, looking at a longer-term time frame. I've put 3 years on here so you can see that, starting any time now, the Bradley model goes down into the 2013. And remember, when you look at this, that this is not it's not telling you the amplitude of the swing. It's just telling you that the time between late March and early 2013, the bias is to the downside. That's just based on the planetary bias of the numbers, the weights of the planets. And you look at this, and it looks like there could be a double top in 2014 in the middle. And all that means is that the market should rally from the first quarter of 2013 into the summer of 2014. That's 2013, have a 5 or 6 month rally. So you can't base anything on amplitude. This is based on the actual weighting of the planets, of whether they're bearish, which is a minus, or a bullish if they're a plus. And that's really all you're looking at when you're watching this. And so this is why you don't want to get too tied up into the thinking it's going to be 100% perfect, because it is far from that. It's more in the area of the 70% range. And believe me, that does better than most of the economists, because most economists don't even get close to 70% of what the market is going to be doing. And so this is why we look at it as a broad indicator of what things could do. And that's really all we're trying to do is to get that little bit of an edge. But with all of these patterns coming together at this time, it's hard for me to fathom that they could all going to break up to the upside. Now, believe me, in 2000, January, February of 2000, in the NASDAQ, they did break into new high ground, but that was a different type of move. That was a once-in-a-generation move where you had, these dot-com companies, just going totally crazy. And, that's the main thing that we're looking at. Now, I've got to take a little break here, but we've got to get to the Treasury bonds, folks, because they are acting so beautiful that this might be the Christmas present that we're waiting to unwrap. 877-927-6648.
Hi, folks. This is Tom O'Brien. If you want to get great trade setups in equity as well as the option market, come over to TFNN.com and test drive my daily newsletter, Market Insights, for 2 weeks absolutely free. Each trade setup comes with a profit projection as well as stock placement. Included in Market Insights is a Twitter alert service. This allows you to take advantage of intraday setups. Volatility is back in the markets. What does that mean to you? To me, it spells short-term opportunity each and every day. The days of trending up on lighter volume are gone. We have come off the highs with volume across the globe. Don't get caught in a complacency trap. Many of the indices have given back 2 months of trading in 1 week. We have a trader's market. You can take advantage of this trader's market by test driving my daily newsletter, Market Insights, free for 2 weeks. Market Insights will give you the edge you're looking for in the markets. Go to TFNN.com, under newsletter, hit the Market Insight tab for your 2-week free test drive right here, right now.
the world of financial markets, there's a new player in town with an exciting new way to trade the markets. Nadex now offers binary options as well as bull spreads in a wide range of indices along with commodity and forex markets. With as little as $100, you can gain access to a new way to trade global financial markets while guaranteeing that your risk will always be capped. Nadex allows you to multiply your trading opportunities in ways never imagined before and access markets you once thought were out of reach. With short-term trading opportunities available, including binary options expiring each hour the market is open, Nadex allows you to take advantage of a variety of market conditions regardless of volatility or market direction. Now is the time to take advantage of this exciting new market. Don't let this trading opportunity pass you by. Open your account today by clicking on the Nadex banner on the front page of TFNN.com. Nadex, a better way to trade.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, we're back, folks. If you have any questions, it's 877-927-6648, and I'll be happy to answer any questions for you. And the main thing that we want to look at now is our Treasury bond chart that we have been waiting for. We've had a really strong stock market, and the bond market has actually held up incredibly well. As a matter of fact, it's up now. We're into that 44 level. We're within about 4 or 5 points away from where we think we're going to get to, and we've been in this really tight trading range, for the last several months, which means that if you were looking at this, just from a breakout point and measured the distance between the breakout point, it would give you, your price objective up into that 149 level, which I think is going to be, pretty important as far as, where I think we're eventually going to get to. This is, I just can't tell you enough that we've been waiting, and, whether it's going to be right or not, and whether we're able to get our price on that TBT at the $16.80 level, I'm not sure, but I'm pretty sure we're going to get the level of the Treasury bonds. Well, I'm not sure, but I'd hate to use the word hoping, but I'm expecting. Let's use the word expecting that we should make that level of that 149. And like I said many times, by the time it gets there, it's going to look like it's going to be the absolute wrong thing to do when we make new lows in interest rates. And interest rates get down below 2.8% on the 30-year bond. That's the same. Now, people have asked me a question, why not buy it at 17? Well, the reason why I'm not buying at 17 on the TBT is because the numbers that we look at, and there's 3 of them there, measure to 1680, and I'm not going to give an extra 20 cents in it if I think it's going to get to 1680. I'm already shading at 10 cents. So this is what I'm waiting for to look at. So we'll have to just be patient and see what happens. Next week, a thing we need to talk to, or at least focus on here a little bit, is the U.S. dollar, because we've had a pretty big move, in the dollar recently, and especially in the Japanese yen. And we talked about this on Friday's show when I was taking over for Tom and Steve when they were doing the road show, and we were looking for the Japanese yen and U.S. dollar to reach that 1.618 expansion level. And today, it reached it with absolute perfection when it hit the 181, 74 level, and the number was 181.75. We backed off 150 pips on that just in the past, 4 or 5 hours. And so this is the first correction that we're going to be looking at. The expansion came in, right at that 1.618 level, and so this is what we want to be looking at to see, what our correction is going to be. Ideally, it would take several days, and we'll get down into that, 78.50 level, which is just a few hundred pips away. Now, realize if the yen has dropped 150 pips in a few hours, you can imagine it can drop 150 pips in another, day or two or another few hours. We could be back down at that 78 level. And this is why it's very difficult to buy into strength in these things, because when they do reverse, they can really hurt you. And that's the advantage of pattern recognition, is that it's a leading indicator. By far it is not perfect, but it does give you the odds of, at least having a pattern and a place to, enter a market and have a reasonable stop protection, and the price, appreciation that you're looking for, or the risk reward, is better than 2 to 1, and most often it's closer to 4 to 1. So that's why we're looking at these as we look at each one of these things that we're following. Now, we have also talked about the dollar index, which has been heading down towards the 78 level, that we think it's going to run into some really strong support, because after the major AB equals CD level that we had complete, the market is beginning to move in a ABCD format, to the downside, and that's why we're really interested in to see if this in fact is going to be a case, where we can actually look to be a buyer of the U.S. dollar down at this 76.50 level. That would be a perfect Gartley buy signal. You would have 3 higher bottoms coming in. You'd have a completion of your larger AB equals CD leg in your longer term dollar index, and of course it stopped exactly at the 82 level. And now, like I mentioned, we are completing a perfect, I think we're in the completion of an AB equals CD pattern down into the 76.50 level. And I posted this into Tiger TV so that if you wanted to, take a look at it, you'd be able to see it and realize that we are getting close to it. The yen is about, I think, 20% of the U.S. dollar index versus the the euro, which is in the 53% range. So it's something that you have to be able to say that, yeah, this is getting to the point where if we get down in the yen and a little bit lower, a little bit higher in the euro, that's going to take us, to the 76.50 level in the yen, because the dollar index should make that 76.50. Now, if it doesn't, that just tells us that it's a lot more bullish than we talked about. Now, I had another question, about the Treasury bonds, and that is, why don't you just, buy the TBT here if you're so bullish, you're so bearish the bonds, and just, hang on for dear life? Well, as I mentioned before, that's not what trading is about. You have to be able to, pick your points of entry so that you don't have to react, too much if you're wrong. I mean, the worst thing that can happen is I go along the TBT now, and then the bonds rally to where I want to go, and now I'm setting with a 3-point or 2 or 3 point loss. I've increased my risk by 3 times, and I've reduced my profit objective by 3 times. And so this is not why, it's going, to the move of where I think it's going to go. So this is what we have to wait and see if it's going to, happen that way. So we want to wait on the Treasury bonds. We've had patience all this time, all during this correction when we've gone up to the 786 to the upside, which is that 145 level, and then we pull down to the 140 level, which is the 50% retracement. We've been in that trading band now for well over 2 months, and so any breakout to the upside will give this enough impetus to take us to that 150 level. So let's just be patient and see what happens. It doesn't take much of news to get it there. We got a call from Mike in Florida. Are you there, Mike?
Yes, Larry. How are you? I hope you had a great weekend. Thanks for everything you do.
Well, thank you very much.
I got a quick question for you. I know that you're primarily futures, as we are too, and I hate to even bring this stock up, but Apple, I trade my daily chart. I trade. I use a 240-minute chart. Could Apple be forming, as we speak here, a bearish Gartley? Could this be the D point? And I hate to even bring it up.
No, I don't think so, Mike. And the reason why is we've exceeded the 786 of the last rally. The high we made at 27. The actual, the market should not have gone above the 786 of this last move. And I'll put this into Tiger TV so you can take a look at it. But we never really should have gone above the 786 level at 17. Now we could be making a double top here. There's a possibility that this 7 or 528, could be a double top area, but frankly, it's the pattern is such that it doesn't really, make it's not as exciting as I thought it was. As a matter of fact, if you remember back on last Thursday, when it was at the 786 at 517. I said, it should stop at the 786, and it backed off about $10 or $12, and then, the next day it gapped up above it, and right now it looks like it's headed higher. That's the only thing that I can say. It looks like it's going to make a double top up in here somewhere.
Okie doke. Very good. Larry, thank you.
Toughest stock in the world. It's the only stock that'll never go down. But
I hate to even bring it up. It's kind of silly, actually.
Actually, I'm not involved in it. It's just that I try to make a prediction on it, and if it just keeps going higher and higher, I just stand aside. You don't have to be. You can only be beaten up so much until you burn your hand on the stove and say, look, maybe I better go look at RIM or something like that. But I spend 80% of my time in futures and forex. So
very good.
Yeah, thank you for calling in, Mike. But the main thing is that the whole world is bullish. The Apple, and I don't believe in the last 20 years every analyst has been bullish the stock. I heard that on Bloomberg, I believe, over the weekend, that this is the first time, I can't remember the exact date, but it was the first time with every analyst at all the firms, there was no negative. There wasn't even a neutral in Apple. So, there could be some
Can I mention something else, Larry?
Sure.
I don't know.
Yeah, please.
I got a letter from our Senator Nelson, and he's calling to make the oil futures market illegal. Says that too many people are trading things that they're not taking delivery for, and it's like, you know what? I take delivery of gas every single day, for God's sakes, and if I want to hedge myself, but I guess you could apply that to everything, but there's a move afoot. I guess that their thought is that anyone who's trading anything that's not intent on taking the delivery shouldn't be entitled to.
Well, no, I think that's going to be a really tough sale, and the reason why is that these markets exist for liquidity and insurance purposes, and also for profit purposes. And the only time we've ever had a default, not counting what happened with MF Global, but the only time we've ever had a renege on the contracts was Simplot. I think his name was Jim Simplot in Idaho Potatoes, going back into the early 70s where he reneged on the contracts, and there was a long, drawn-out suit. And what happened was it just lost all interest in Idaho potatoes, and they just quit trading. And it was actually a pretty good vehicle for trading at that particular time. But he ruined the market because he basically had a monopoly on it, and that's what made it so difficult. But now, with crude oil as big as it is huge, and there are actually 5 major firms across the world. But none of them are in the U.S. There's one in the United Kingdom, there's one in the Netherlands, and there's 2 in Singapore, and I believe the other one is in Malaysia. And in fact, none of them are in Dubai or any place like that. But they are the larger, people of these hedge funds, or not hedge funds, but people that actually, are moving the physical oil. And that's why it's, I don't think they're going to get that done. I mean, there's a lot of politics that goes with that, and, there's a lot of money in those contracts, so they're not going to let that go, for sure.
Very good, Larry. Thank you.
Yes, thank you, Mike. I appreciate you calling in. Thank you. Okay. The next market we want to talk about, is the crude oil market, because we've had a breakout, above that, 106 level. And then, last night, the market swings quite, dramatically there. So a 2% move in crude oil happens, every few hours or so. And all we did was come down and test the 786 of the low we made on Friday, the 24th. And then we had another, rally back up for another $1.50 in crude oil. So it's just in a little tight range now, backing and filling, trying to find out which is the next support for the next move up. But frankly, folks, the crude oil market looks like it wants to go to 122. The only way that I would change my mind on the crude oil is if we went below 103. Then I would say this was a false breakout, and that 110 level would probably be the high. But I wouldn't, bank any money on false breakouts given these markets, because they're going up, they're backing off a little bit, giving you a chance to buy them. And, so that's really what you're looking at. You broke out in gold, you broke out in the market for crude oil, and so, you haven't broke out in silver yet, but it's getting very, very close. I want to cover the gold and silver market, too, because I think, we've had an interesting phenomenon occur just on the ratios of, where we were at the time of when they broke out before. So I'm going to post into Tiger TV the relationship of the gold and silver. Here again, we're going to be looking at what the price of spot gold has done versus the price of spot silver going back to last May. And you can see these patterns that we're looking at. We had a big AB equals CD bearish-Gartley pattern in the silver up around $44 an ounce, and then it made the ABCD pattern to the downside at $26 an ounce. It made the double bottom, and then since that time we had a rally. Since late December 29th, we've rallied up into this same level of $36 an ounce, which was the exact price that we made back in November. And then if you'll take a look into Tiger TV, you'll see the yellow line is the price of gold, and gold actually did not take out that high from last November. That came in at around the 1792 level, and we only got as high as 1780 in that particular point. So we're in a strong congestion area right now. I believe if we pull back enough, we'll get a good place to buy, gold, and it looks like it's higher unless we go below, 1750, and then I will change my mind. We've got a break coming up, so it's 877.
At Tiger Metal Exchange, we pay you more for converting your jewelry to cash.
Let's go to Brian in New Jersey. Hey, Brian, what's going on?
Hey, Tom, just want to let you know I did give you some jewelry. My jeweler offered me about $650. I should get a check in the mail tomorrow for about $1,200.
At Tiger Metal Exchange, it's all about honesty when converting your jewelry to cash.
Okay, let's go to Paul in Florida first. Hey, Paul, what's going on?
I want to commend you on the Tiger Metal Exchange. I just did a deal with you guys the other day.
Oh, good.
And very happy.
Well, I appreciate it. Now, did you sell us jewelry or did you buy coins off us?
Yeah, I sold you jewelry.
Okay.
Yeah.
Awesome.
What we weighted at was less than you guys said, so, you're totally honest.
At Tiger Metal Exchange, we give you the tools to value your gold, and it's absolutely free. Call 866-618-8888 or log on to TigerMetalExchange.com. We've created the easiest, safest, and most honest cash for gold process. Tiger Metal Exchange. It's the only call you need to make.
TFNN is proud to bring you the cutting edge of investment newsletters. Ken Shreve's Ultimate Growth Stocks. Ken is a top-down investor who lets price and volume in the major stock indices tell him when to be in the market and when to be out. By using his unique blend of fundamental and technical analysis, Ken will protect your hard-earned capital while realizing breakout gains. Go to TFNN.com today, click Investment Newsletters, and get Ken Shreve's Ultimate Growth Stocks free for 2 weeks.
Would you like to discover the next great tech stock? David White, TFNN's technology guru, has just launched his new newsletter, The Technology Insider. In his newsletter, David will be looking for those shining stars that may turn into the next Apple, Microsoft, or Cisco. David combines his technology background as a software programmer with his market skills as a successful professional trader to give you this unique newsletter. We're on the verge of the next great tech run. With the Technology Insider, you'll be in front of the run-up and not lagging behind. David is developing a long-term investment portfolio. Therefore, we're only offering the Technology Insider as an annual subscription with a remarkable price of only $395. That's right, for a little over $1 a day, you'll receive the fundamental technology wisdom and technical trading skills of the Technology Insider David White. What are you waiting for? Go to the front of TFNN.com, click on the link on the front page, sign up for your 2-week free trial, and become a Technology Insider today.
Here's what people are saying about Tiger TV.
Let's go to John in Tampa. Hey, John, what's going on?
Hi, Tom. How are you, sir?
I'm doing great. You having a good day out there?
A wonderful day. I love your Tiger TV. I watch it every day. I'm like a kid in a candy store.
Oh, man, I appreciate you out there watching it. How long have you been watching the Tiger TV?
I'm watching almost a month now, and it's wonderful.
It's pretty cool, isn't it?
Oh, yes, it's cool. You see the charts and everything. Thanks so much for the hard work.
Tiger TV, a great news service from TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and we have 2 things to cover before we end the show. One is one that we've been watching now for several weeks, and that's the natural gas. We have, been talking about these 786 retracements that we've had, for weeks now. And the high we made last Thursday was exact 786, and we actually talked about look for the next 786 on the downside, and we certainly reached that level today. So we want to keep an eye on that. And the reason why is, we've posted this on the long-term basis. This is a 21-year low in natural gas, and the relationship between natural gas and crude oil on a spread basis. In other words, the price of oil is going up so much faster than the price of the natural gas that it's going to make a point where at some time in the future where natural gas is going to be quite valuable just because of an alternative energy source. So we want to be watching this because this is the same pattern that we're looking at in natural gas, this long-term pattern that we had in the Japanese yen when it was down at the 73 level and then again at the 76 level. And so this is the same type of pattern that we want to be watching. they're both they're not related to each other in any stretch of the imagination. But this is this is why we're watching it. So right now it's got that lot of support down to this 247, 245 level. We want to keep watching that and to see that it's doing it. Now I want to end the show on the keep watching stocks, of course, because I think these divergences that I talked about at the beginning of the show are very important. I spent a lot of time over the weekend looking at these, and they are very important. They don't look important now, but in a few days or maybe a week, you might be looking behind yourself, wondering where that man with the sickle is, because these things are really really interesting as far as the patterns and the divergences that we have going now. Now we want to end the show with taking a look at the TBT, because I believe a lot of people are watching that just because of that long-term pattern that we have in the Treasury bond market. And the reason why we're holding out for this 1680 level, in fact, I've shaded it by about 20 cents. The number is actually 1662. So if we could make new lows into December, that would get us filled, and that would complete the pattern. And at that point, we would be very close to the price in the bonds that we're waiting to see. If they can make that 148 to 150 level, and as we get there, we'll get a little closer. And I'm still following the puts and calls on these darn things, but frankly, boy, they are just, somebody is willing to buy puts up in here and pay a premium for them, and which is very unusual, because usually when markets go up like this in Treasury bonds, the puts would be going down in price. In fact, they're holding up relatively well. So who knows? People have asked the question about the QE3 and all this stuff, and believe me, the first chart that I posted was going back to 1987, which was that Black Monday, October 19th, and that's when the your plunge protection team, which was really the very first Q1, whatever you want to call it, when they opened all the vaults of all the banks and said, just start buying stocks. We stopped going down today. That was Mr. Greenspan. And that's pretty much what happened with the gentleman Paulson. What happened in October, November of 2009. So these markets will still trade in the cycles, but we want to be patient and wait for this 1680 and this and the TBT, and also keep our eyes on these bonds up at these levels, and also keep watching the price of 1370 in the S&P 500, because it's a pretty important spot. I don't think it'll mean much if we go above it. If we close above 1385, then I will say there's something probably wrong, and made a major mistake in all these cycles that I've been doing. And I do that occasionally, but it's not often. But I'll be prepared to eat crow again if that in fact happens. So